Hello, everyone, and welcome. My name is Philip Palumbo. I'm the host of the Palumbo podcast, where we interview some of the most successful founders of businesses, professionals that serve founders, market strategists, and economists to help us stay on track as it relates to our money. Today, we have with us Dennis O'Rourke, who's a partner at Moritt Hock Hamroff. He serves as chair of the firm's corporate M&A and Securities Practice Group. Dennis has over 20 years of experience in handling all facets of complex mergers, acquisitions, securities offerings, corporate transactions, and general counsel matters. Dennis is an experienced negotiator and takes an innovative and creative approach to advising clients on their business objectives and providing practical solutions. His approach to serve as general counsel and trusted advisor to his clients, assisting them in numerous legal and business matters and situations, and he believes that his clients benefit from his multi-practice area experience. Dennis provides advice on client matters such as privacy issues, employment and equity incentive arrangements, and other general corporate matters. So it doesn't get better than having Dennis here assist us with understanding all the landscapes as it relates to M&A. Dennis went to Hofstra University and graduated in 1995 and United States Naval Academy in 1989 and played Division I lacrosse there as well. So Dennis, it's great to have you here, and thanks for your time today.
Oh, thanks, Phil. Thanks for having me. I appreciate it.
Absolutely. So Dennis, with your experience, one of the things that that my firm focuses on is helping business owners and founders really get a sense of where they stand as it relates to their business, and are they really mentally prepared for the exit plan. Many times people think of it as dollars, right? But I know, and you know, that it's much more than that, right? So I look at it like there's three parts. There's your business, there's the financial readiness part, and there's the personal readiness part. So from your experience, when you sit down with founders and through your network, what's the psychology behind exiting a business?
Yeah, well, it's changed a little bit in recent years because what used to drive these transactions was the emotional part, the business owner being emotionally ready to sell and then engaging in a transaction. But in recent times, because the multiples have gotten so high from predominantly the private equity folks, which again drives the industry buyers as well. Now the economics are driving the psychology, where the psychology used to drive the economics. Now the economics are driving the psychology.
Wow.
And quite honestly, people are being offered so much money, they just can't say no. I mean, it's happening on a very regular basis.
Wow. And so what is your view of that? So private equity, they're just flushed with cash right now that they have to put money to work, and they're offering multiples to be able to do that. Would you agree with that?
Absolutely. That's at play. And again, you probably know this statistics better than I do. We have an aging business owner population. And coupled with that is that oftentimes their children and family members don't want to be in the business. So therefore, when you combine those three factors, a ton of private equity money out there, an aging business owner population, and a next generation that really is not interested in taking over the business, you see the activity that we see today.
So Dennis, if these business owners, if they feel they have no choice but hit the bid because the money is so amazing, then they go to sell the business. What is their lifestyle like thereafter? How do they feel when you talk to them 6 months later or a year later?
Well, for a lot of our clients, it's providing a financial security that they never had before, right? So you kind of get two groups of people. One group where this is a complete life event for them, where they've never gotten a $50 million check before, and they've made a nice living up until that point. They're getting a $50 million check, which is a life-changing event for them. They're doing cartwheels, right? And then you have the other group of business owners who have made a ton of money along the way, and they're selling it maybe for a higher number. Right. And it's really just, that's where the emotional side of it comes in more than the first group of people. And they're just ready to stay. Like you said earlier, they emotionally gotten to the point where they're ready to pull the trigger.
And what would you say you're seeing in terms of like average age of a founder who's selling their business nowadays?
Oh, it could, I would say mid 40s to mid 60s.
Wow, it's a big range. And those who sell in the mid 40s, early 50s, do you find that they're moving on to another business?
Not in the same industry because they have a restrictive covenant, but no, the general approach of those folks is I could figure out what to do with 30 or 50 or $70 million in the bank.
Yeah.
I'll figure it out after that happens.
Mm-hmm. Before we get into the details of the whole M&A transaction, et cetera, just to stay on this from a personal level, right? When these founders sell their businesses for 30, 50, 70 million plus, and they receive all this money, again, in your experience and talking to them 6 months later, a year later, I'm sure a lot of them become friends of yours. Do you feel like many of them have managed their money in a smart way, or they receive all this money and they make not the greatest decisions?
Well, most of them are okay. The part that they need to get over is that they need to understand that they're going to sell their business for all this money, but that money is not going to throw off the cash flow. When I say money, the cash flow on an annual basis that the business threw off, right? So if you have a business that has $5 million of EBITDA and you sell it for $50 million, right? That $50 million is probably not going to produce the income that a $5 million EBITDA company produced on an annualized basis. So it's sometimes difficult discussions, and that's when we bring in people like you to have with the client to say, you're going to sell your business, get all this money, and if you want to keep that money, your lifestyle is actually going to have to reduce, not explode, right? It's going to actually, you're going to have less available cash to you than you had when you owned the business. And that sometimes is a shock to a lot of people.
Yeah, and that's why the personal readiness piece of it really is. So we have this concept in which I wrote a book about, as you know, called Make Work Optional, which is working on your terms and nobody else's terms. Working because you want to, not because you have to. It's the ultimate way to have financial independence. And part of that is exactly what you are saying is that's why it's the personal readiness, in my view, is so important, because if you get a great bid for your business, you're like, oh my gosh, I have to take that. I'm going to net 20 million or 30 million. The question is, if you're 50, 55, is that really going to be enough money for you to live on for the rest of your life based on the exact lifestyle that you're used to? So, and oftentimes, Dennis, I find that a lot of business owners are spending a lot of money through their business. They don't really understand what their true expense or the true lifestyle cost is. So I know somebody, for example, that had a bid for like 300 million. But when he did the math of it, after taxes and everything, believe it or not, his share of that would not be enough for him to maintain the same exact lifestyle that he's used to, which is a very high-end lifestyle. So he decided not to sell the business. So the personal readiness is so important to this, even though, like you said before, PE is throwing money at these businesses. But if it's not the right number for them and there's a chance that they're going to run out of money down the road, even though, Dennis, many people look at it like, oh my gosh, this is 20 million, this is 30, it's so much money. How are you possibly going to run out of money? The reality is that people's lifestyles are accustomed to a certain level. Like you just said, somebody has EBITDA of 5 million. If you sell your business for 50 million, you're probably not going to get the same level of income net to support the lifestyle. So that's why the personal readiness is extremely important.
No, I agree. And the question that I often ask clients is, when you assess selling your business, you have to think of the future a little bit, and none of us have a crystal ball, but I say to them all the time, is it more likely that you're going to have a business 20 years from now that throws off $2 or $3 million a year, or is it more likely that you're going to be out of business because there's going to be a change in technology, there's going to be competition, there's whatever. So if you're being offered in a sale 15 to 20 or years worth of money that you would traditionally took out of the business, it's hard to say no to that, because most business owners say, yeah, it's a higher likelihood this business isn't going to be around in 20 years than that I'm still going to have this business throwing off the same cash flow that it's throwing off now 20 years from now. So that's a question, but there are some people that say, no, my business is going to throw off more money 20 years from now. And you say, okay, well, if you love it and you enjoy it and you're young and this is what you want to do, then there's may not be a good reason to sell.
it's really a great way to think about it because as a business owner and any of our business that we're in, you do wonder what is a business going to look like in 10 years from now, 20 years from now. We all know we're doing a business now and what EBITDA levels we're in today, but that's not guaranteed in the future. So it's always as a business, and Dennis, many people's net worth, most of it is tied up in their business. It's not like they have 5 or 10 million laying aside that they transacted through their business and invested. I mean, some own real estate at those values when they had extra cash from their business, et cetera. But most of the money is tied up in their business. And essentially what you're doing as a founder is you are betting that the future will be here for your business and you'll be generating the same EBITDA levels that you're doing now, and if not much, much more. So it is this mindset and vision that many people have. Do you agree with that?
Yes, I mean the notion that you're turning in a liquid asset into cash should be very attractive to most people. I mean, it's because there's no guarantee that you're going to be able to liquidate that.
Right.
Your business isn't a liquid asset unless you sell it, right? And to have the opportunity to turn that a liquid asset into a pile of cash, to me, is very attractive for most people.
Yeah. So Dennis, walk me through exactly what you do. I'm a founder. Tell us exactly what you do.
Yeah. So if you come to us and we're a law firm, so I'm a lawyer. We give legal advice, but above and beyond that, we try to give clients advice on how to. Everybody says to me, Dennis, what do you do for a living? And are you a corporate lawyer, right? And I say, no, I'm really an exit lawyer, right? I really help clients take their illiquid asset and turn it into a pile of cash. And that can be done a number of different ways. But at the end of the day, the earlier you speak to a lawyer that knows what they're doing and through that process, right, selling your business or going public or successfully exiting your business, it's not an accident, right? You should have a game plan in place for how you're going to go about doing it. So you should be looking at, if you're in a certain industry, you should be looking at what are the bigger companies in my industry? What are they looking for? What types of companies are they acquiring? Are they paying serious, large multiples? Or what do the public markets want to see, right? If you have an interest in going public, and you should grow your business in that direction, right? And so if you have trusted advisors, lawyers, accountants, wealth management firms like yourself, if you have trusted advisors that work together and understand how to successfully exit a business, that's really at the end of the day what we do. Doing contracts and setting up equity plans and all those things, that's all well and good. And right, that's the nuts and bolts of what I do every day. But there's a bigger picture there. And it's surrounding yourself with advisors. As a business owner, you should be surrounding yourself with advisors who can help you get to where you want to go.
Yeah, so we talked about business, personal readiness before and financial readiness, but on the business aspect, when you come in and you're talking to a founder of business and do you recognize that, hey, this business is only trading at 5 times EBITDA when we know your competition's at 10 times? Do you do that analysis for that particular founder as he's approaching or thinking about exiting?
Indirectly. I mean, we don't run, that's more of an investment banker, the technical, what are the multiples in your industry and what are your competitors trading at? But we have a pretty good feel from doing so many of these deals of where the client sits. And most importantly, we have a pretty good grasp on what buyers are looking for in the businesses they buy. And, for example, the one thing we tell clients on the sell side all the time, they say, what's the one thing you can do to make your business valuable? And I tell them something that sounds counterintuitive to them, but it really makes sense when you think about it. I tell them, make yourself invisible, right? Make your business run without you.
Yeah.
Because when the buyer buys your business, they want a business that's self-sufficient, self-sustaining, with a management team that self-perpetuates the success. If the business is too reliant on one person or one or two people, right, that actually turns out to be a negative, not a positive. So, run your business so that your business runs itself and doesn't need you. And that, again, back to the psychology, that's difficult for a lot of people to hear. But that's, in my opinion, that should be their goal, to get good management, empower your management, incentivize them through various different ways, through equity compensation, through cash compensation, through bonus plans, incentivize your management, get their buy-in, and then let them flourish. And then you have a business that is self-sustaining, which that's what buyers want at the end of the day. Buyers want self-sustaining businesses that aren't going to tank the second one person walks out the door.
Yeah, I mean, that's really, really great advice. So if you're working with a business where you notice that it is very much CEO founder dependent, and that founder is thinking about exiting, what type of advice, is given to that founder? Do you say to them, hey, listen, take the next 6 months or a year, figure out new management, your business has to be run efficiently without you to increase the EBITDA multiple. Do you recommend anything in that realm?
I mean, the main thing is to incentivize your key people, right? And you could do that through equity compensation, through equity incentives, giving them ownership in the company, getting it to them in a tax advantageous way. And you could also do it via cash compensation, a change of control payment, a phantom equity plan, a bonus plan. There's various different methods for all of this. But at the end of the day, your management wants to, right? So if you're an owner and right now your business is worth, $20 million, but if you get management buy-in and grow your business and have
Right.
people in, and it becomes worth $50 million, right? Would you rather own 100% of $20 million or 80% of $50 million, right? So it's worth it to give up the reins a little bit and to give up the equity and the cash a little bit, because you're going to get, if you do it right and you have the right people, you're going to end up in a much better place, even though your personal ownership may no longer be 100%.
Right. Right. So sometimes you have to give up a little bit to get a lot, right? So take 2 steps back to take 1 step forward. It's basically what you're saying. So stay in-house if you can with management, incentivize them. And if you do all that, you may have to give up some equity, but at the end, your multiple will increase and it'll be well worth the investment. What about concentration, where the business is concentrated in just in a few customers within the business? What do we do about that?
Yeah, I mean, it's not necessarily a problem, but it's a concern, right? So if you get 80% of your business from 10% of your clients, a handful of really good clients, that's going to be a problem, right? And again, not a problem. I use that term loosely. It's not as attractive as a company whose customers are, the revenue base is spread out over, no one customer makes up more than 3% of their business. All right. So you have to make the effort to, not rest on your laurels because you have 2 or 3 really good clients. You should try to get some of those other clients to even out the scorecard a little bit.
Yeah. So how about legal pitfalls? So what legal pitfalls do you found need to know about in the M&A transaction?
I mean, the hot button topics today, it's always been, so let me start with the big picture, right? It's always been the hot button topics are, for the most part, anything that involves the government, right? So employees, taxes, environmental benefits, those kinds of hot button topics, because that's where, the government has more liberal rights to go after the new owner than private creditors do. So anything that involves the government has always been kind of at the top of the list, but specifically now, the big one we see is employee classification. So you have to watch having independent contractors because the definition of independent contractor is, the definition of employee, it has been expanded both federally and in most states to include people that you may have traditionally thought were independent contractors, perhaps should have been classified as employees, right? That's up there on the list, certainly without restrictive covenants. It can be a hot button. Litigations that aren't cleared up. Then you get into UCCs and tax liens and things like that need to be cleared up. And then the other one that, from a straight business point, is can get tricky is what your accounting principles are. So are you a accrual basis or are you a cash basis? And those two things, if you're on a cash basis, it makes your life easier now. But when you try to sell your business, most buyers want accrual basis financial statements and accrual basis, companies. So switching from cash to accrual early may be a really good idea.
Yeah, I found that I have a client right now who's looking to sell their business, and Dennis, they really spent the money on a quality accounting firm. CLA is the name of the accounting firm, and that really helped tremendously. Before that, they was sort of a disaster, but now they spent a lot of money, but the money that they spent was well worth it because the bids that they're getting are tremendous. So working with the right accounting firm is really important too. But most of the time, Dennis, that these founders they don't want, and business owners, they don't want to spend the money. So any experience with that as it relates to hiring the right accounting firm prior to sale?
Yeah, I mean, you absolutely need the right accounting firm, like you need the right law firm, like you need the right insurance person, you need the right wealth management team, you need a deal team of sophisticated advisors that could give you advice that's going to maximize your money. Because if you don't show all your profit, or if you are on a cash basis, when the conversion happens and the add backs happen, you never get 100%, right? So you got to remember, when you're selling a business at 10x, 12x, 14x EBITDA, right? Whatever you lose today in terms of cost or expense, by maximizing your profit, you're going to get 10 to 14x that down the line, right? So that's generally speaking, that is a great trade-off for a business owner, right? It's just, and to get that, you need, so if you need to spend a little extra money on a good accounting firm or a good lawyer or a good insurance person who could structure you the right way that maximizes your EBITDA, you're going to get that money back in multiples, right? It's an investment in your own company that you're going to get back, 10 or 14 times over, whatever it's going to be. And it's just short-sighted to say, I don't want to spend the money on this accounting firm that could help me get to where I want to go.
Yeah, I tell you, one thing I recognize in life, I think you could probably agree to this, is that the cheap man pays twice, right? So,
That's right.
since it's true that, since I launched my firm, there's been certain expenses I've looked at, and you try to maybe go the cheap way out on a few things, but then you recognize, what, if you're building something of quality, it's worth to spend a little bit more, and in doing so makes it a tremendous difference. And I can only imagine when you're getting ready to exit, spending money on the right attorney, right? I mean, everybody's always looking to shop. There are times when you should shop for things to get cheap prices, right? And there are other times when you should be with the very best, because the very best can yield you a tremendous amount, especially with a liquidity event like your business.
Absolutely. Penny wise and dollar stupid, right? You can't, you just can't, it's not the right time. Again, you don't necessarily need to go crazy and hire whatever, or spend money that doesn't make sense, but you need, at the end of the day, I always tell people, we sell sophistication, right? At the end of the day, that's what I sell is
100%.
Right? And that's what good advisors sell. Yeah. If you're in a situation where you need the sophistication is, if you need it, right, you don't really have a realistic choice, right? It's just money you're going to have to, spend on sophisticated advisors, and you should spend it, whether it's an investment banker, a lawyer, an accountant, an insurance person, a wealth management firm, a valuation firm. It doesn't matter. You need sophistication when you're going to go down this path.
100%. There's one area, Dennis, where I did spend up a lot of money, and that's on my golf clubs, because I thought actually it was going to improve my game, and it really didn't help a lot. So in golf, I don't think that applies.
but that brings up a very interesting point. Like, we see owners all the time. They spend money on their cars. They spend money on their clothes. They spend money on their house. They spend money on their golf clubs. They spend money on their golf club, right? But yet, when it comes to professionals, they don't want to.
They don't want to spend the money.
It's always a weird thing to
Oh my gosh, it's funny you saying that, right? Because like sometimes people, there are many people that just do it yourself as it relates to investing, and I'm like, oh my goodness, if you pay me 1% or maybe even a 0.5%, depending how big your account will be with me, and like just in 1 year, I can save you, millions of dollars that would pay for your fees for the rest of your life. It's like, so it's like the little
Yeah.
things and the sophistication that makes all the difference in the world.
Yep.
So in terms of so what are the most important terms founders should negotiate in an M&A deal that you've found from your experience has been very helpful? One or two things.
Yeah, purchase price is purchase price, right? So the key to all this is the key on purchase price, and we'll keep this quick on purchase price, is cash up front, right? I always tell every client, if you're not willing to do the deal for the cash you receive at the closing, you have to rethink this, right? So that's obviously purchase price. A couple of other things that our clients, that in our experience is overwhelmingly number 2 on the list to purchase price, is the liability cap. The liability cap for a seller is what's your risk exposure as to how much money you're going to have to give back the buyer if there's a problem with the deal, right? And that is because sellers want peace of mind, right? They want to know, unless I've done something really bad, like committed fraud or not paid my taxes, I'm going to walk away with blank dollars, right? Even if there is a problem. And that is accomplished via the liability cap. The other thing in today's world and again, it's the product isn't recent, but it's come downstream a lot to deals, is rep and warranty insurance. And rep and warranty insurance is you could buy, when I say you, I mean the buyer can buy it, or the buyer gets it. How they split up the premium cost is up for debate. But you buy a insurance policy that insures the seller's representations and warranties. So if there is a problem in the transaction, the buyer has an insurance policy to go after, and hopefully not the seller. So if I were going to say 3 things, it's cash up front, it's liability cap, and it's rep and warranty insurance. Those are the 3 focus areas in today's world people should be focused on.
As far as common structures are concerned, right? So, I mean, I've heard so many different structures, right? 50% up front, and then there's a workout where you'd still work in the business maybe for 3 years, and then you get paid the rest over 3 years. Then there's 5 years. What have you found? And maybe there's not a common answer to this, but is there a common structure that you see more of than others?
We like to get at least 75% cash up front, if not more. And then the back end payment can come in the form of a couple of things. It could come in the form of rollover equity, where the seller takes equity in the buyer entity as part of the purchase price. And you need to make sure that's structured in a way where the value of the equity the seller is receiving is tax deferred, which we do all the time. You could have a seller note, or you could have an earnout, right? The seller note and the earnout are somewhat problematic. Right? I'm not sure the most recent statistics are on it, but they're not great. The statistics of sellers getting paid are not great in those sectors. So you want to minimize. You can't avoid it because it's the world we live in today, especially with interest rates upticking a little bit in recent years. You can't avoid some kind of cash back-end payment, whether that be in an earnout or a seller note. But you want to minimize those and get as much protection around those as you could reasonably get.
Yeah, so I'm hearing a lot, Dennis, that the 75% upfront, really, that's great. But then the 25 with 30% if the deal's less than 75% upfront, that a lot of these founders are having a hard time receiving the rest of the money. Do you find that to be common?
It's much more common now than it used to be. Yeah. Yes.
I know you were talking a little bit about that, and you broke up a little bit too, but so it's more common today because of higher interest rates?
No, the use of earnouts and seller notes are more common today. I think the reason for the non-payment is because buyers are paying such high multiples that they want a company that's really perfect. And if there are even the slightest problems, it flows through the earnout or the seller note.
Right. So in a situation where let's say I'm a buyer of your business, right? I gave you 75% up front. The other 25% we're going to work out over 3 years. And then all of a sudden I'm like, you know what, Dennis? This didn't work out the way I wanted to work out. I'm not paying the other 25%, right? So how hard is it for you, the seller, to sue me and win to get the other 25%?
In all honesty, it depends on the size of the payment, right? Because in today's world, litigation is so expensive.
Right.
To sue someone over a small dollar amount a relatively small dollar amount, it doesn't make a lot of sense oftentimes. So in those situations, you're going to have a buyer and seller, and they're going to work something out. And in most of these situations in general, something gets worked out. The sellers probably don't get paid in full, but the buyers probably pay something, right? That's what happens most of the time. If it's a big enough number, like I said earlier, you need to make sure that you have built-in protections, especially around an earnout. So things like the buyer can't materially change the business during the earnout period. The buyer, right, in order to make major changes to the business, you need the seller's consent.
Right.
Sometimes you can get those things in deals, sometimes you can't, but you should at least be trying as a seller to get some kind of guardrails around what the buyer can do during the earnout period. You should get some concessions on that, because it's difficult to have a buyer who could come in and do anything they want, right? Because that puts you now really at risk in a way that you shouldn't be at risk as a seller, right? There's always some risk. Everything's at risk that you don't get it closing, but you want to try to minimize that risk. And when you have skilled people who have been around the block a few times on these transactions, like, the pressure points of where you could push and where you could, where you could push a buyer to, hey, you got to give me something on this, to give me some guardrails. It can't be carte blanche. You get to do anything you want. And you're generally successful most of the time at getting some guardrails around that earnout when you can, but you can get some guardrails usually. And it's important. It's really important.
I'm sure it is. And that's a big part of what you do, correct?
Yeah. We pride ourselves on there's two reasons you hire, well, more than two, but two major reasons you hire a lawyer, right? One is a lawyer who has the experience and the skill and has done enough deals to know where the pressure points are and where you can push and where you really can't push. But the main reason you hire a lawyer for these deals is you need to hire someone who is creative, right? Because in every deal, there's going to be issues where the buyer and seller disagree, right? And it's usually not a great use of time for the seller to try to convince the buyer they're right and for the buyer to try to convince the seller that they're right. So if you have two good lawyers involved in the deal, that conversation quickly transitions to, well, how can we come up with a solution, a creative solution that both of our clients can live with, that allows the seller to sell the company and the buyer to buy the company, and for us to have a successful closing. And that's really, at the end of the day, what you're looking for in a lawyer is someone who can be creative and come up with solutions that work for everybody.
I mean, it's tremendous. It really is tremendous. I want to finish off with 2 or 3 minutes. It's a big subject here, but I think it's important for everybody to learn about it. A couple of questions here. So when it comes to private equity firms, right, and then you have strategic buyers. So when we say strategic buyers, we're saying existing companies in the existing industry that are looking to buy another company who strategically makes sense to add value to the existing business. But private equity companies, they're buying into your business to add it to their portfolio. Is that right?
Yes. Uh-huh.
Okay. So as a lawyer, is it easier to work with a private equity firm, or is it easier to work with a strategic buyer?
It's easier to work with the buyer who gives you the better letter of intent and the better deal. It doesn't matter what the
doesn't matter.
If you have a buyer that's giving you 90% up front and they're getting rep and warranty insurance and all those kinds of things, I don't care if that buyer is a strategic industry buyer or a portfolio buyer. It doesn't matter at that point. I don't find that there's a whole lot of difference between the two. It may, where it does come into play, right? And it gives just strategics a little bit of a leg up in the process, in the sale process, is what's very important to a lot of sellers is their legacy. They care, most sellers that we represent, if not all, care very deeply about their employees, care very deeply about the brand, care deeply about their employees, care deeply about the management. And
I want to stop real quick. So do they care enough that they would take less money?
Oftentimes, I shouldn't say oftentimes, sometimes, yes, absolutely.
I believe it. I believe it.
Yes.
Sorry.
Yeah. It's, people like to portray, the evil capitalist and all that stuff. It's really the most benevolent people in the world to me are business owners that care about their employees and their legacy. And they genuinely do. And they are absolutely willing to give up money out of their own pocket to make sure that their employees and that their legacy continues.
Yeah, listen, I've seen that, and I see it with my own self. I mean, I'm sure with you too. I mean, with my own business, I mean, starting from 22 years old, building to where I am at today after 25 years, and the sweat and equity that I poured into it and work with my clients. I mean, that would be the first and most important thing by far. Versus, I mean, the money aspect obviously would be important, but that's tremendous because it's everything that we've built. And I've seen it myself with clients I have now who sold their business and how important the continuity of the brand and then who's going to be taking over it, because you have to think about your employees too, right? So now your employees are going to be working with somebody else. So you just want to make sure that person, that they're being handed off to the right person so they feel comfortable and happy. And you're right, that's a big part of the whole thing. It's such a this whole process. I find it fascinating. I love working with founders because I'm a founder and there's so many synergies and we understand each other. And there's so much in a way of psychology in this process. And like you said before, if you have the right professionals around the founder, that are skillful and sophisticated, and I mean everything you said, Dennis, right? That if you're a founder listening to this, I mean, it's so important that you hire the right person because it can mean millions to you and your family for a lifetime to come. So I'm going to leave it off with anything else that you would like to add to this conversation that a founder who's listened to this that would want to know.
Yeah, I mean, I always like to end these type conversations, and again, thank you for having me. But
of course,
if somebody offers you life-changing money, you probably need to take it. And that's really what the message at the end is. As emotional as it may be, it may not be the right time in your life. It may not, but it's very rare in life that somebody offers you life-changing money. And when it happens, you need to really, really think long and hard about saying no to that.
Yeah, I just finished off with this quick story, Dennis, because you find it interesting. My wife and I, we were traveling, and my family, we were in Florida, and my children were playing basketball with this other young child, and this father was watching them and observing. I went over to the father, and we started talking. He asked me what I did. I asked him what he did, and he sold his business for a half $500 million, right? And he said to me, and I said to him, I said, "That's incredible." I said, "How long after you had the business did you sell?" And he told me like 40 years. And he goes, "And Phil," he goes, "when I was sitting at the table to sell my business for $500 million," he didn't tell me the number. I actually looked it up and I saw it, but I understood what he was saying when he was telling me this. And he said to me, he goes, "I was sitting at the table and everybody at the table asked me what took so long to sell my business." He goes, "Because I had offers for 50 million. I had offers for 70 million. But I just kept on going, And so, to your point, like some people, Dennis, they see like even 50 million, 70 million, this guy knew was life-changing money, right? But I guess he just had this belief that he can get multiples of that over time. And that's a pretty big bet.
Well, listen, it's always good to be driven, right? And the most people you have the most respect for in the world are generally the people who are the most driven.
Yeah. No, I agree. Dennis, this was awesome. You're a good friend of mine. I appreciate you being on here today. you're the man that if anybody is thinking about exiting a business, I've seen your work. We've talked about it. You're so knowledgeable. You're so skillful. So thanks for coming on today and educating my audience. I really appreciate it.